Perfect. Thanks everyone for being here. Thanks for coming to Tech Chicago Day. This is a big event. This is a big event. A lot bigger than last year. Excited about this conversation with Sach about the future of fintech, the state of fintech, and the future of fintech. The founder of Jump Capital. So let's get to it. Should be a lightning 15 to 18 minutes talk. I'd love to hear about the story behind the firm inception, around how it came about, and also kind of like the beginning story of you as an investor, but also tell us a little bit of the origin story of Jump Capital.
Sure. So thanks for having me. When you invited me, I thought we'd be doing this like as a Ferris wheel carpool karaoke thing, but this is just as good.
A lot better.
I co-founded Jump about a little over 10 years ago, and back then, if you just rewind the clock, there's a bunch of VCs I see in the audience. There was probably like 7 to 10 firms very active in tech investing at that time, based in Chicago. If you fast forward to now, the ecosystem is incredible. It's probably like 50 VCs, at varying sizes, different industries, et cetera. So part of when we started Jump, we were seeing a chasm or a gap in Series A, which our definition of Series A is typically about $1 million in revenue, usually looking for that's around $4 to $10 million in a check size. And when you looked around in Chicago, it was a lot of seed stage investors. So there was a gap after you raised that first round. Where are you going to get your next round? And again, if you rewind the clock back then, there weren't a lot of VCs from the coast coming to Chicago on a regular basis. It's changed dramatically in the last 5 years, I would say. So we were trying to fill that void. I would say two, for us, we're ex-operators. So between my partner and I, we've started to run 6 companies. And our philosophy was we wanted to engage a little deeper than just giving a check and walking away. And as I joke, in the VC world, if you did a trade show of just VC booths, it'd be the same exact phrase, beyond capital, what else can I provide? We're here to support you. So we were theoretically doing that before, but I think what we try to do is fill a void on capital and then help with an operating lens. And then the last piece is we always wanted to be thoughtful capital, so we go really deep into areas, fintech, IT and data infrastructure, areas that we think that we can be a little bit more subject matter experts or at least additive, and then to be able to kind of have an intellectual debate with entrepreneurs.
You've mentioned fintech as and I'm curious, what's the size of the fund currently?
Yeah, so we're right now on our 7th fund. It's a $350 million fund. We closed that end of 2021 and have about 60 or 70% of that core fund to deploy still. Yeah.
So you've mentioned fintech as an area of focus. Obviously, that's a super wide area, and that's under a lot of pressure in this environment currently, to say the least. Yeah. Where are you still seeing opportunity?
Yeah, so within fintech, that's about, I would say loosely, about 60% of our fund or our effort. Within fintech, I would say there's a lot of pressure in the last 4 to 5 years. If you look back, companies that just took free cash and tried to deploy it on growth at any cost. I think that's almost a given at this point. Everybody knew that. So models that were really focused on customer acquisition, really spending a lot of money to go get new customers and figure out how to monetize them, really have a lot of pressure and issue. Two is a lot of these business models required a lot of cash, and I would say that if you're a Series B, C, D, E, kind of company that is trying to raise money, incredibly hard right now. You have to be hitting perfection to raise that money. And so models that are a little bit more efficient, models that are typically B2B, I would say, or at least have a channel approach of efficient acquisition of customers, are usually the big ones. As far as categories, we see 3 trends within the fintech world. Number one is there's consumer behavior that's just radically changing. How they think about money, it's just accelerating at a clip where people are trying to get control of their own finances. And we think the RIA space really needs to be enabled with better tools to enable wealth managers and the like to have a better conversation. The second is, if you look at any industry, but I would say the fintech especially, the last 4 or 5 years, they just threw people at problems. So think of compliance. Compliance has been growing like crazy. They just throw people at problems, and so JP Morgan now spends $1 billion on just compliance, management. And then the third for us is compliance and regulatory. For us, that's a sector that, yes, you may be able to get efficiencies, but there is radical amounts of regulation and government oversight that's going to increase here. my general rule of thumb is when a macro economy goes up or down, usually something dramatic happens in the political landscape where they want to solve problems for people that were hurt by that. So we think that it's going to accelerate, and you're seeing it in the news like every day with FTC, SEC, et cetera, et cetera.
And how's the current environment impacting the way that, Jump is investing? I think.
You mean how are we, like you mean the macro environment?
Yeah, the macro environment. Yep.
Yeah.
Yep.
So yeah, I would say that like the world was, in 2021, was a little irrational, the FOMO, a fear of missing out, drove much of the venture industry. I think the last year and a half, especially last year, was like this digestion period where people were just trying to take their money and figure out, what do I do with it? VCs were allowing their portfolio companies to do what they needed to, but to rationalize their spend, get more efficient, et cetera. I think we're kind of in that rationalization stage where all VCs, and I would use us as an example, we're very, very methodical when we're making decisions. Now, what does that mean? I would say that every deal that we've looked at that we liked, that we either wrote a term sheet or wanted to go after, has 3 or 4 term sheets. So what does that mean? That just means good companies are obvious. Ones that are not getting anything. And so it's a very have and have not kind of environment. We're in the middle of a term sheet right now, competitive situation. And just it requires you to be much more thoughtful of where you make those bets. But everybody's noticing it at the same time. So checks are being written, be more thoughtful. And our pace, I would say our pace is about half of what we deployed 3 years ago.
So let's talk about AI because that's on everyone's mind right now. It's funny, like 20 maybe 20 years ago, we was talking about AI with Allen Iverson, but now it's like a completely different. Few people got that joke, and it's okay. So let's talk about AI, not Allen Iverson. Where do you see the greatest potential in disruption? Because like right now it feels like there's a lot of hype, a lot of trend, but what are you seeing as like a good for potential?
Yeah, I mean, when my teenage son, has a chatbot in Snapchat and shows it to me, it's like everywhere right now, right? So it's kind of, I would argue that any VC, whenever I say or somebody says there's this company that does Gen AI, they roll their eyes. Like I think we've been in this hype cycle so fast that people are in the trough of disillusionment. We're really kind of at a point where we're trying to figure out where's this going to be used. So for me personally, I think there's a lot of really interesting public use cases, retail use cases, consumer use cases. But if you start going into the enterprise, we're super early, really, really early. People need to figure out how to do controls, how to put the governance around the data, cleanliness of the data, where's the data coming from, being able to understand if their models work. Just there's like this comfort that you need to have when it goes into a black box. And enterprises don't really have that yet. There's not the tools to do that yet. And if you're thinking about fintech, which I know this is more about fintech, in fintech, I can assure you they're not running it that hard. They may say they're playing with the tools, and they are, but I think it's more on efficiencies and less things on the front line of helping consumers. So you're not going to see a ton of chatbots out there. You're not going to be seeing like underwriting done by AI. Just those types of things are not going to happen in the near term because they don't have the controls and infrastructure yet. The second thing I would say, and just to be completely like out there, like I think white collar, low level jobs are in real concern right now, right? Anything that is mundane tasks, think of things in accounting, tax, consulting, you should be worried, right? Because you can automate a lot of those. Now it just means higher order thinking, critical thinking kind of roles, but just means there's going to be less jobs there, my personal opinion. And so then the third thing I'd say is, for me, like what I get really excited about is like where we invest, it's all the infrastructure stuff. And there's a lot of opportunities, but it's going to be the human enablement. How do you get them to feel like they're in control?
And can you quickly talk about how you're seeing any changes in your own portfolio companies around AI? Any?
Yeah. I mean, I just had a board meeting yesterday, and I brought up Gen AI, and I got a bunch of looks around the room, like, I played with ChatGPT kind of thing. So I think you have a spectrum of companies even in my portfolio, that like I'll wait and see, I'll see how this plays out, to the other end of the spectrum where they're, maybe even rebranding as a Gen AI company, right? I would say that we've tried to take a more thoughtful approach. We're trying to up-level my entire team to be really deep in it, because even if you don't invest in the space, it's going to be impacted. We're trying to coach our companies on how to use it to make you more efficient with your development, with your operations. There's a lot of tools to do those things. But I think the hard part now, and this is a personal view I have, which is buying versus building is going to be, there's going to be a compression in that. So maybe just put it a different way. If you're a strategic, if you're Microsoft and you would have bought a company, you're now probably going to debate whether to buy it or just to build it off of an open, kind of source platform. If you're doing market maps of areas, so say you're in fintech, hypothetically, and you do a market map, people that were in a box will now have the ability to jump boxes. And that brings a little bit of chaos, I think, to most companies. So we're trying to make sure our companies are being thoughtful of this disruption, the challenges of the competitors that can enter, be more efficient, and then, of course, just make sure you're aware of what's out there, but don't be running at it. Like I'm definitely one of those people that say don't run at it yet, because things are still forming and we're in like really early innings.
Shifting gears to more banking, as we're talking. This is more a conversation about the fin and fintech, which is finance. How is SVP and the regional banking crisis that occurred back in March, kind of impacting investing in Chicago, you think?
It seems like a long time ago. Yeah. Anybody in venture or a startup that had money at any of those regional banks probably feels the pain we did. I mean, we were knee deep in that. My first comment would be the venture ecosystem is built off of money. Shocking, right? Shocking revelation here. But the money comes from kind of 4 or 5 sources. One is venture capital. 2 is venture debt. And typically within that subset, you usually are getting the money from more venture funds that are forming. I can assure you there's not more venture funds forming, right? If you look out 2 years from now, I think there's going to be less venture funds than there are today. That's a personal view. I think part of it is interest rates are higher, the bar is higher to get returns, and so people have choices of where to put their money. I also think there's a lot of funds that were formed in the last 3 or 4 years that made FOMO type of investments. So you're going to see the good quality kind of separate. The third thing is like exits. You're not seeing IPOs. You're not seeing Google buy a ton of companies. And when you don't see the cash come back, you usually can't get people to invest in your fund. So it's a very circular kind of economy, if you will, in that way. So the VCs are slowing how they invest, as we've already talked about. If there's less funds, that also reduces it. On the banking side, there are a lot of new and or existing venture debt providers that stepped up to fill some of the void. But I would say it's very clear there's less money in that area. They're being tighter on it. They're not giving it to everybody. And so what does that mean? Just there's less money out there, which is, again, like anybody that's in this economy probably says, yeah, of course. Probably appropriate. But like when you go through such a drastic shock like we went through in March, it makes it more painful. Yeah.
So from a city standpoint, we're going to shift gears into like more Chicago. Your investors in LA, New York, and a bunch of other places, but you're headquartered here in Chicago. Would you have any thoughts about the current state of Chicago tech ecosystem? Like, how do you think about it?
Yeah, I mean, I love Chicago. I'm based here, of course. Most of our team's based here. I see a couple of them in the audience. And we have a New York office. So being a fintech investor would be impossible not to be in New York, to be honest. What I love about Chicago is most of the companies come with founder market fit, right? They usually come from like the transportation industry, they come from the finance industry, trading, they come from CPG, and then they build a company. I would argue that a lot of other areas, and it sounds like, oh yeah, of course, everybody should be doing that. That's a very Chicago thing. If you go down to Austin, if you go to Denver, we have investments in all these markets, so I'm a fan of all these markets in different ways. They're like different children or something with different love. But the difference is you find a lot of people building ideas and then trying to figure out where and what industry to put that idea towards. And so from my view, like Chicago tends to go start with the industry and the problem set and then build the company versus figuring out a cool new technology and figuring out where can I apply it. So I'm bullish. I will say that Chicago, when I talk to VCs, they're here way more often from the coast. They have portfolio companies here. And I would tell you that the best thing that could have happened to Chicago, which sounds ridiculous, is COVID. Like all the VCs on the coast started Zoom investing, and now they have board meetings here. And when they have a board meeting here, they tack on meetings with other companies and VCs, and so it's got a very circular kind of reinforcing mechanism. So I'm bullish. We have some pain in the macroeconomy, but I think it's better than a lot of other cities in the middle of the country right now, personally.
As we're concluding, one last question, a quick one. What's your favorite restaurant in Chicago?
What's my favorite what?
Restaurant in Chicago?
Oh, man. So maybe I'll give, you know where I went yesterday? I went to Armitage Ale House, which anybody that knows the place, like, I've been trying to get in there for like 3 months, which seems like lunacy, personally, because there's so many good restaurants. That was pretty good. So I'd put that there. I'm a pizza guy, so Spacca di Napoli is one of my favorites. Yeah, and for me, I love Indian food. So one of the lesser-known Indian restaurants in Chicago is Vajra, V-A-J-R-A. Yeah.
I've never been to any of these places. I'll stop by.
That's what I'm here for.
Sach, thanks so much for doing this.
Yeah.
Appreciate you. Next is... next will be Sam Yagan, who will be coming out.
How you doing? What's up? Of course.
Appreciate you. Both Sam and Sach really need no introduction in Chicago. Sam is someone that I admire a lot because I know someone I looked up to when I was trying to get into the tech space in Chicago, but also I used to work for Sam at SharpRunner. And Sam has always been not only a great friend, personal friend, but also a great mentor to me in my career. Whenever I'm thinking of a next move, whenever I'm, when I'm thinking about things that are way above my mind can go, is a phone call that I make, and he always takes it. So, so shout out to him. So we're gonna talk about his founder story, and from the days of SparkNotes, OkCupid, and the other stuff he has going on with Corazon Capital, and then kind of his thoughts on the state of the Chicago tech ecosystem. So, let's talk about like being a founder. What are the most important qualities and characteristics that contribute, to your entrepreneurial success?
I mean, I think it's simultaneously the total willingness to fail and the refusal to fail simultaneously. I think everything I have done, I have gone into fully expecting that the most likely outcome is failure. And you then spend the rest of your time desperately trying not to fail. And I think it is that combination that I think you have to look for in founders, that I look for in founders when I'm, as an investor or as a mentor. Fear of failure is what will most, I think, kill founders and startups.
When it comes to strategies businesses can employ to stay ahead in transforming environment, what are some key trends or technologies that people should be aware of?
Are you thinking like bigger companies or startups or?
Thinking. I think this is a very startup environment, so let's think startups to kind of growth stage companies.
Look, I think we operate in, startups are in the most dynamic part of what is generally a very dynamic industry, right? And so one of the most important questions to ask yourself is when do you stay committed to the path you're on, and when do you pivot, iterate, innovate in your own product. And this is something I see founders struggle with all the time. I recently had a company in our portfolio that had raised at a pretty healthy price, raised $8 million, and then one day called me and said, "I don't think this is a good business." And I said, "Okay." And he said, "I'm going to fire everybody who works for me, and I'm going to come up with a new idea." Right? So that was someone who like had the realization that to stay on the path, which is the easy thing to do, was going to end up in failure. The hard thing to do is to have the conversation with your investors that A, the thing I just pitched you literally 4 months ago, I'm out, and I'm just going to try again on an idea that you don't know anything about. So that's, I think that's like one of the really ultimate examples of like this idea of I'm operating in a very dynamic environment, and to say AI like for the 1 millionth time today, like I think a lot of founders are coming in and they're saying my value proposition or my technology or my product is threatened by what's happening, and how do I react to that? And again, fear is what will always will kill you, and so you have to just kind of lean in, and I think you have to really think in the very long term.
You started a few companies. You started SparkNotes, which sold. OkCupid also sold, and I'm sure and now you're doing Crowds Capital. Let's talk about some like unexpected key lessons you learned as a founder. I'm sure that's a very long answer, but yeah, what are some unexpected key lessons that from all the journeys that that you've been through?
I mean, there's like 1,000. What do you want me to focus on? I can talk fundraising, talk co-founders, can talk sale processes, talk the role of luck. I mean, there's just like everything.
I would say fundraising and kind of the early days of founding.
I learned the hard way that choosing your co-founders is the most important thing you do. It's more important than what business you choose. It's more important than even who you take capital from, although that's a close second. I have been in a situation where I've had to fire a co-founder, which was something that I hadn't even contemplated when I co-founded my first company. So I just think I got very lucky that every other co-founder I've worked with, except for this one, ended up being someone who 10 times smarter than me, very good friend to this day, like in each other's weddings and stuff like that. But this, the cost of making a bad co-founding decision can break your business. I think similarly, getting the wrong investors can do that, and I see founders all the time. In fact, I'm in a conversation with a founder right now, and founders can get so focused on valuation, or can get so focused on the name of the firm or whatever, and can really, I think, forget that you're in a decade-long, like if you're in a success case, you're in this business for a decade. If you're building a great company, you're gonna be in this for a decade. And especially early stage investors, these are the people who are gonna have your back. Like these are the people who you're gonna be most aligned with. As you get more and more money, you're likely to get more and more misaligned with your investors. It's your earliest stage investors who are the people who are ultimately gonna be most aligned with you, economically, probably philosophically. And I see people put, just take the most, the best valuation, or someone who seems like it's a big industry name but doesn't know anything about startups. And I've been in boardrooms and on cap tables with people who I see lead the founders astray and ultimately like really damage the business. So I have been very blessed to have co-founders and capital partners who have really helped me, grow to be the person that I've become and have the successes that I've been very fortunate to have.
For those people in the room that don't know the OkCupid origin story, could you kind of go over kind of like how it all came about? And I've always thought it's a really interesting story.
We had been dabbling when we started SparkNotes. We had been dabbling in some online dating products in the late '90s, but we were always intrigued by the dating is just a cool category to be in. It's sexy, and we were a bunch of Harvard math majors, and so we needed all the help we could get, doing something interesting. So, and we were always intrigued by, the early days of online dating, where, and this was back when like only losers online dated. At least that's what all the VCs told me when I tried to raise institutional capital, and you had all these people out in the market who basically were these old dudes who were trying to like sell women that they could figure out who your soulmate was. Like this is eHarmony, the old guy, Dr. Neil Clark Warren, and Dr. Phil was the Match spokesman. And they would be like, oh, we know who your soulmate is. And we were always like, that's not the problem. You're all solving the wrong problem. The problem in dating isn't I don't know who to date. The problem is I don't meet enough people, right? People have been knowing who to date forever. Like that's how we are all here, literally, is we had people, our parents figured out how to date. And so it's a volume problem, not a matching problem. And so that was sort of the biggest problem we saw in the market. The actual founding story was my partner and very, very good friend, Chris, was at a bar on the Lower East Side of Manhattan one day in 2002 on a Friday, and he called me and he was totally drunk, and he said, I want to start a dating site. Yes, I said site because this was 2003. There were no apps. And he's like, I want to start a dating site, and I wanted to have a big button called the blind date button, and people are going to come, they're going to hit the button, and we're going to set them up on, the computer's just going to set them up on dates. And I was like, that's a terrible idea. And so hung up, and I was like, he'll never remember this. But he calls me the next morning, really early, for someone who had been drinking so much. And he's like, what do you think of my idea? And I'm like, you're not serious, are you? And he's like, we're totally doing this. And so then we spent the next 6 months sort of thinking about, okay, let's say you did want a website with a button, which nobody wants. What would you do? And then we were like, well, you have to build a website with a lot of people. You have to build a standard dating site first. So that was how we got to OkCupid, and we decided to really emphasize, this idea of having as many people as possible, which sounds obvious to you, but every other dating site to that day had focused on fewer people with a paid model versus a freemium model. And so we were the first of the sort of free online dating sites and products that are now ubiquitous down the road.
What a lot of people, I think a lot of people in this room that are kind of like a newer generation of people that are in Chicago Tech probably don't know is that you co-founded Accelerate Labs, which is now Techstars Chicago. Tell us a bit about why you decided to do that, and how do you think the Chicago tech ecosystem has shifted over the past 10 plus years, and where do you think we're still lacking in our process?
Okay, well, I'll start by sort of talking about failure, and then I'll get back and I'll say some contrarian things about where we are now. So I moved back. I was born and raised in and around Chicago. I went to the coasts for school and startups, and then I came back in 2007. And I tried to sort of meet people in the community here. And I had the great privilege of living in Boston, New York, and San Francisco, so I thought there were tech communities everywhere. And I got back here, and the very first year that I lived in Chicago, I was trying to network with the community, and I met 8 people. 8 in a year. Like literally the number of people in your row, like I met that in a year. And so I was like, well, okay, and there were interesting people doing things in all, in the suburbs and, in Ravenswood and all this, but there was no community. And so I was like, oh, we should do something about that. And I then, was doing some research and found that in 2009, there were 19 companies that did Techstars. Only 19 companies in all of Techstars. 5 of the 19 came from Chicago and left to Boston and Boulder. So I was like, oh, there's definitely there are great founders here, and they're leaving in droves to these other places. So I had the brilliant idea of we should have our own version of Techstars here. And so we called Techstars, and they had no interest coming to Chicago. And so a group of us were like, well, we should just do an accelerator. Do you know how much money we tried to raise for our accelerator? $330,000. That was what we needed to run a year. And so I was like, oh, this will be so easy. I'll go to all the VCs in town. They'll each throw in 25 grand. It'll be so easy. And I went to all of the named VCs that you all know, and I got laughed out of every single one. And they were like, we will not give you $25,000 because this is certain to fail. And I was like, it's $25,000. Who cares? You spend more than that on sponsoring an event, whatever. And so 2 firms ended up doing it, and that first class of Techstars had some great companies in it. that demo day that we had at the House of Blues in 2010 was like one of the great days of my life, and I think of the history of the Chicago ecosystem. So this was a story where everybody thought we would fail, and the probable outcome was that we would fail. But we were like, we're not going to let that stop us, and so we built it. Fast forward to where we are now, I think we're in a bit of a rut. What's the last great tech company to be founded in Chicago? That's still great.
You're doing your talking.
We can do call response.
I'm just asking the questions.
I'm just saying, like, I was at a dinner recently sponsored by someone you might know, and everybody went around the table being like, how come we don't get the credit that the coasts get? How come people look down and, we're not San Francisco? And I just said, what's the last great tech company that was founded in Chicago? Okay? I'm not saying there aren't any. I'm just saying you go to a lot of other ecosystems and you're going to have people in a fist fight over which is the best company. Okay? And we have great companies here. I'm a supporter of them. I'm an investor in a lot of them. But we don't have these like runaway, where's our sort of generational company here? So I think the challenge that I would throw out is we need more outcomes. We need more outcomes. And the challenge to the founders here is let's aim bigger. And let's stay independent.
When you say outcomes, how big of outcomes you're looking for? How do you think we'll get there?
I think it's a combination. I think we don't have enough capital here. I think we don't have enough. I think we have a lot of companies have sold prematurely when they could have gone on and built bigger businesses. I think we have had companies that have not been as responsive to markets and willingness to. I don't want to get into specific companies, but I can think of 3 companies that were market leaders in their category that got surpassed by other people because the other people were willing to think bigger and were willing to think about their own, sort of what the next evolution of the market could be. In the same way, like when I was running Match, nobody at Match wanted Tinder to happen. But when we started Tinder became 10 times bigger than Match. Okay, and that is what that was the thing that made disrupting Match so special. And I have not seen a similar willingness for people who have gotten to that billion-dollar valuation, billion-dollar plus, to say, okay, we're not going to disrupt ourselves. And how do we go 10x that? How do we do something that makes everything we've done to date obsolete? That's the challenge.
Good note to end on. Sam, always keeping it real, my guy. Appreciate you. Thank you for coming to the talk.